School of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 5 Emerging Issues in Finance, Unit 14 Behavioral Finance, Part 1. After completing this unit, you will be able to explain the meaning and concept of behavioral finance, discuss the characteristics of behavioral finance, describe the various behavioral biases and their impact on investor behavior, and appreciate the behavioral considerations for investors. Introduction. Traditional finance, as developed and enriched by several economists, has dominated the subject of finance since the mid-1950s. The main premise of the traditional finance model is that individuals are rational. As a result, investors act rationally and the stock and bond markets are efficient. Financial economists assumed that people or investors act rationally when making financial decisions, whereas psychologists have discovered that economic decisions are made irrationally, challenging this premise of traditional finance. Investors can make poor financial judgments because of cognitive mistakes and severe emotional bias, resulting in irrational behavior. The study of behavioral finance has expanded over the last few decades to investigate how personal and social psychology influence financial decisions and investor behavior in general. Psychologists and sociologists have challenged orthodox finance and economic ideas for decades, claiming that humans are not rational utility maximizing actors and that the markets are inefficient in the actual world. The subject of behavioral economics evolved in the late 1970s to address these challenges, amassing a large body of evidence of people acting irrationally regularly. Thus, it is a concept developed with the inputs taken from the field of psychology and finance, which tries to understand various puzzling observations in stock markets with better explanations. It is a field of finance that proposes psychology-based theories to explain the underlying dynamics of assets, buying and selling behavior. Meaning of behavioral finance. The study of the influence of psychological processes on the behavior of financial practitioners and the effect on the market is known as behavioral finance. Investors' market behavior, according to behavioral finance, is based on psychological decision-making concepts that explain why people purchase and sell certain class of assets. Behavioral finance is concerned with how investors interpret and act on data to make financial decisions. Meaning of behavioral finance. The study of the influence of psychological processes on the behavior of financial practitioners and the effect on the market is known as behavioral finance. Investors' market behavior, according to behavioral finance, is based on psychological decision-making concepts that explain why people purchase and sell certain class of assets. Behavioral finance is concerned with how investors interpret and act on data to make financial decisions. Further, behavioral finance emphasizes investor behavior, which leads to a variety of market anomalies. The study of investors' psychology when making financial decisions is known as behavioral finance. Due to the use of emotions in financial decision-making, investors fall prey to their own and occasionally others' blunders. Therefore, it is the study of the effects of psychology on investors and financial markets. It focuses on explaining why investors often appear to lack self-control, act against their own best interest, and make decisions based on personal biases instead of facts. Definitions. The behavioral aspects that are taken into consideration while making decisions are varied. It is based on two concepts, cognitive psychology and limits of arbitrage. Different authors have tried to put this theory in their own words. Some of the definitions as given by different authors are: Swell. Swell defined behavioral finance as the study of the influence of psychology on the behavior of financial practitioners and the subsequent effect on markets. Sheffrin. Sheffrin defined behavioral finance as it is the application of psychology to financial behavior, the behavior of investment practitioners. He considers behavioral finance as a rapidly growing area that deals with the influence of psychology on the behavior of financial practitioners. Lintner G. Lintner G. opined that behavioral finance is a study of humans interpreting and acts on information to make informed investment decisions. Another author, Olson R. asserts that behavioral finance seeks to understand and predict systematic financial market implications of the psychological decision process. Glosser et al. Glosser et al. Considered behavioral finance as a subdiscipline of behavioral economics, incorporating findings from psychology and sociology into its theories. Further, they consider that the behavioral finance models are usually developed to explain investor behavior or market anomalies, whereas rational models provide no sufficient explanations for it. Belsky and Gilovich. Belsky and Gilovich refer to behavioral finance as behavioral economics. They further defined behavioral economics as combining the twin discipline of psychology and economics to explain why and how people make seemingly irrational decisions when they save, invest, spend, and borrow money. W. Forbes. W. Forbes felt that behavioral finance is considered as science how psychology influences the financial market. This view emphasizes that the individuals are affected by psychological factors like cognitive biases in their decision making rather than being rational and wealth maximizing. M. Sewell. M. Sewell has stated that behavioral finance challenges the theory of market efficiency by providing insights into why and how the market can be inefficient due to irrationality in human behavior. M. Schindler. M. Schindler tried to explain it by giving certain examples like investors' biases when making decisions and thus letting their choices be influenced by optimism, overconfidence, and conservatism. It further states that experience and heuristics help in making complex decisions. Thus, behavioral finance is defined as the field of finance that proposes psychological-based theories to explain asset market anomalies. Within behavioral finance, it is assumed that the information structure and the characteristics of market participants systematically influence individuals' investment decisions as well as market outcomes. Scope of behavioral finance. Behavioral finance is an area of study focused on how psychological influences can affect market outcomes. It can be analyzed to understand different outcomes across a variety of sectors and industries. One of the key aspects of behavioral finance studies is the influence of psychological biases. The areas of behavioral finance are: Number 1. To understand the reasons for market anomalies. Even while normal finance theories can explain the stock market to a large extent, there are still numerous market oddities such as the emergence of bubbles, the effect of any event, the calendar effect on stock market activity, and so on. Standard finance leaves many market abnormalities unsolved, whereas behavioral finance offers explanations and solutions to a variety of market irregularities. Number 2. To identify investors' personality. An in-depth look at behavioral finance can aid in recognizing the many types of investor personalities. Various new financial instruments can be devised to hedge the unwanted biases caused in the financial markets once the biases of the investors' behaviors are detected through the study of the investor's personality. Number 3. To enhance the skill set of investment advisors. This can be done by providing a better understanding of the investor's goals, maintaining a systematic approach to advice, earning the expected return, and maintaining a win-win situation for both the client and the advisor. And number 4, helps to identify the risk and develop hedging strategies. Because of various anomalies in the stock markets, investments these days are not only exposed to the identified risk but also the uncertainty of the returns. Thus, behavioral finance explains various corporate activities. Characteristics of behavioral finance. Behavioral finance is typically characterized by certain key features. They are: number 1, framing. The decision maker's perception about a problem and its possible outcomes is what is referred to as the decision frame. It is affected by the presentation, person's characteristics, and perception about the question despite the fact remaining the same. Psychologists refer to it as frame-dependence behavior. Though the objective fact remains constant, the market participants are subjected to context sensitivity, simply failing to see how questions are asked. In stock markets, framing has to a great extent affected the choices of participants adversely. Number 2, heuristics. It refers to a process by which people find out things for themselves, developing rules of thumb. This often leads to other errors. Heuristics can also be defined as the use of experience and practical efforts to answer questions or to improve performance. The irrational way markets act at times can be explained with the help of heuristics. Interpretation of new information requires identification and understanding of all heuristics that affect financial decision making. Some of these are anchoring, representativeness, conservatism, etc. Number 3, emotions. Most human decisions are driven by human needs, desires, fear, fantasies, etc. The term animal spirit given by John Keynes indicates the inner urge of market participants to engage in more investment and consumption. Emotions have a very important role in explaining investor choices, which thereby shape the financial markets. The psychological reality that affects investment decisions is determined by our emotions. Most of the times, emotions are the main reason for people not making a rational choice. Number 4, impact on market. Behavioral finance believes that market prices do not appear to be fair. According to standard finance, market prices will not be affected by investor mistakes because if there were a variation in price from fundamental value, rational investors would exploit this opportunity for their profits. The other limiting factor is arbitrage. Thus, there exists a possibility that correlated cognitive errors of investors can affect market prices. Behavioral considerations. There are certain points that an investor should consider while investing, like number 1, biases and heuristics apply to all. Human beings are usually imperfect as psychological and emotional biases like overconfidence, anchoring, representativeness, etc. are present in most of us. Better awareness about how to control our emotional responses will not only let us get rid of those, but will also increase the awareness of investors at the time of investing. Number 2. Limitation of knowing. There is a tendency among people to think that the forecasts made by them are increasing in accuracy with the increase of information. The quantum of information is not important, rather what you do with it matters. One should not get paralyzed by the overload of information and not confuse familiarity with knowledge. Number 3. Focus on facts. Asset prices should be judged on facts and not on their prices. Market participants should tune out investor noise and should focus on hard facts. One must think in terms of enterprise value and not stock price. Number 4. Overcoming loss aversion. An important quality that market participants can have is to sell off his or her mistakes, that is, loss-making investments, and move on without coming back the same way the person has made a loss. Investors should examine their mistake as it is not always due to bad luck. One should admit one's mistakes and learn from them, but do not preoccupy the mind with them. Number 5. Information not to be taken at face value. One should think carefully about how the information is being presented because even easy to recall events are less likely, so investors should avoid projecting the immediate events into the future. Market participants should not strongly hold on to historical perceptions or irrelevant data, avoiding seeing patterns in the market that don't exist. Number 6. Don't allow emotions to control you. It is important to be aware of the inherent limitations of the human mind and behavior. Investors need to be aware of strong group psychological behaviors like herd investing and mental accounting, which usually don't seem to be good investment strategies. One should not be afraid of making an incorrect investment decision and feeling stupid. It was very simple that you didn't know it anyway, just happened. Number 7. No investment horizon. No market participant should try to become rich quickly. Investors should go for investments in the stocks rather than options, forgetting a leverage-based investment strategy. Investors must diversify their portfolios and trading could be minimized. Targets for buying and selling are to be set and adhered to. Applications of behavioral finance. Capital Asset Pricing Model or CAPM and the Efficient Market Hypothesis or EMH are based on rational and logical assumptions. These theories assume that people for the most part behave rationally and predictably. Theoretical and empirical evidence suggested that CAPM and EMH and other rational theories did a respectable and commendable job of predicting and explaining certain events. However, as time went on, academics in both finance and economics started to find anomalies and behaviors that could not be explained by the theories available. While these theories could explain certain idealized events, the real world proved to be a complex place in which market participants often behaved very unpredictably. Thus, people are not always rational and markets are not always efficient. Behavioral finance explains why individuals do not always make the decisions they are expected to make and why markets do not reliably behave the way as they are expected to behave. Recent research shows that the average investors make decisions based on emotions and not logic. Most investors buy high on speculation and sell low in panic mode. Behavioral finance is a new academic discipline that seeks to apply the insights of psychologists to understand the behavior of both investors and financial markets emerged. It helps us to avoid emotion-driven speculation leading to losses and thus devises an appropriate wealth management strategy. Branches of finance. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. There are two main types of finance: standard finance and behavioral finance. Let us discuss each of these in brief. Standard finance. Standard or traditional finance refers to the currently recognized theories in academic finance. The contemporary portfolio theory and the efficient market hypothesis are at the heart of mainstream finance. Harry Markowitz developed contemporary portfolio theory in 1952 to explain the expected return, standard deviation, and correlation of a stock or portfolio with the other stocks or mutual funds in the portfolio. Any combination of stocks or bonds can be made into an efficient portfolio using these three concepts. An efficient portfolio is a collection of equities that assumes market risk or has the least amount of risk for a given expected return. The efficient market hypothesis, or EMH, is another major concept in traditional finance. The efficient market hypothesis says that all information has already been represented in a security's price or market value and that the stock or bond's current price is its fair value. Proponents claim that because stocks have reached their fair value, active traders or portfolio managers cannot deliver greater long-term returns that outperform the market. As a result, they argue that rather than seeking to outperform the market, investors should just own the entire market. Even with the preeminence and success of these theories, behavioral finance has begun to emerge as an alternative to the theories of standard finance. Behavioral finance. Standard finance has been the prevailing theory in academic debate for the past 4 decades. On the other hand, scholars and investment professionals have begun to investigate behavioral finance, an alternative theory of finance. Behavioral finance aims to explain and increase people's understanding of the emotional aspects and psychological processes that affect people who invest in financial markets. Overconfidence, cognitive dissonance, regret theory, and prospect theory are 4 themes in the field of behavioral finance. These 4 topics served as an introduction to the numerous distinct themes that have emerged in this discipline over the previous few years. Behavioral finance encompasses insights from behavioral economics, psychology, and microeconomic theory and is more than just a discipline of finance. Because of the influence of his or her varied psychological and mental filters, investors frequently struggle to identify the most cost-effective alternative when making financial investments. When an investor seeks financial advice from a broker or a professional, their decisions may be influenced by market information or the techniques of other brokers or experts. Behavioral finance assumes that investors are not rational in the real world. When it comes to investing, investors make mistakes. They not only make mistakes, but they make them frequently. Behavioral finance is a discipline of finance that studies a variety of stock market events and occurrences that occur as a result of human behavior. Buyers and sellers with diverse perspectives on how prices or asset values will change generate trading platforms called capital markets. Investors make decisions based on their knowledge of asset demand and supply in the market. To put it another way, a market's existence is contingent on what investors or market participants think of the assets. As a result, behavioral finance is the study of investors and financial markets' psychological influences. It explains why investors often lose control, act against their interests, and make decisions based on personal prejudices rather than facts. Behavioral finance explains how human emotions, biases, and the mind's cognitive limitations in processing and responding to information affect financial decisions such as investments, payments, risk, and personal debt, and it may be analyzed from a variety of viewpoints. Stock market returns are one area of finance where psychological factors have an influence on market outcomes and returns, although there are several other aspects to consider. The behavioral finance model was proposed by psychologists, but the finance sector was hesitant to adopt their viewpoint. The psychologist Daniel Kahneman and economist Vernon Smith, who were given the Nobel Prize in Economics in 2002, were the first to address behavioral finance. This was the point at which financial economists began to believe that investors act irrationally. Even in financial decisions, the human brain uses shortcuts and emotional filters to interpret information. Behavioral finance is a word coined by psychologists and economists to represent a concept that integrates the two areas. Its goal is to better understand the several puzzling aspects and anomalies in asset markets to design for better returns and lower the risk. These traits or abnormalities were previously labeled as market anomalies since they could not be explained under the neoclassical framework. To address the growing number and types of market anomalies, a new approach to financial markets called behavioral finance had emerged. The study of the impact of socio-psychological factors on the price of an asset with a focus on investor behavior and decision making is referred to as behavioral finance. Financial theories. Now, in a nutshell, an attempt is being made to trace the genesis of behavioral finance theories from classical finance theories. For many years, traditional financial theory has assumed that investors are properly informed when making financial decisions. However, the reality, particularly during the previous 2 decades, indicates that these assumptions are incorrect. Even if they are well informed, investors have been shown to engage in illogical behavior by acting on emotions. Behavioral researchers have expanded their studies in this field as a result of increased awareness of the role of human psychology in investment decisions. As a result, behavioral finance theories were created with this in mind. To better understand behavioral finance, let us discuss traditional finance beliefs. Number 1. Both the market and investors are perfectly rational. Number 2. Investors truly care about utilitarian characteristics. Number 3. Investors have perfect self-control. And number 4. They are not confused by cognitive errors or information processing errors. Now let us compare traditional finance theory with behavioral finance. The traits of behavioral finance are: Number 1. Investors are treated as normal, not rational, where normal implies that investors' decisions are influenced by greed, fear, and biases. Number 2. They have limits to their self-control. Number 3. Investors are influenced by their own biases. And number 4. Investors make cognitive errors that can lead to wrong decisions. Behavioral finance is now considered a distinct discipline from standard finance, which refers to the currently accepted ideas. The modern portfolio theory and the efficient market hypothesis are the foundations of mainstream finance. The three ideas of expected portfolio return, deviation of returns from the expected, and correlation of one stock with the others held in a portfolio are well known in modern portfolio theory. Merton Miller and Franco Modigliani's arbitrage principles, Markowitz's portfolio construction principles, Lintner and Sharpe's capital asset pricing theory or CAPM, and Fisher Black, Scholes and Merton's option pricing theory form the foundation of standard finance. To construct a unified theory, these approaches use some basic components. The modern portfolio theory, which treated investors as fully rational decision-making entities, emerged in the 1950s and early 1960s. It was also accepted that the best information about basic values was included in stock prices and that prices varied as a result of excellent and reasonable information. The modern theory implies that investors make judgments based on anticipated utility theories, norms, and principles, and that they produce an unbiased forecast about the future. The efficient market hypothesis, or EMH, is a finance hypothesis that asserts that the financial price of goods and securities being exchanged is rational and represents all available information. These theories, on the other hand, fail to explain excessive volatility, and several key facts about stock markets, average returns, and individual behavior are difficult to grasp. Although CAPM, EMH, and other theories performed admirably in terms of predicting and describing specific events, they struggle to explain anomalies and unpredictable behavior. Behavioral finance, unlike previous theories, does not assume that purchasers are rational decision makers or that property or security charges reflect the true or inherent price of each deal. This is a study of the effects of psychology on buyers and financial markets. It also argues that humans, including consumers, have emotions such as fear, hope, and greed. As a result, it focuses on understanding why customers commonly appear to lack self-control, behave against their own best interests, and make decisions based solely on personal prejudices rather than facts. To put it another way, it is a financial add-on paradigm that incorporates behavioral components into the decision-making process. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.